2020 will go down as a year of COVID, but on the whole, it's been a pretty good year for the mining sector, or more specifically, some of the underlying metals. And of course, some of the mining companies have found it tough because of COVID, because they've had to close mine production. But those that have been in production have really benefited from higher prices. And of course, the restricted supply means that it keeps prices buoyant. Let's take a look at what we're expecting now into 2021 with a specialist in the mining field, and that is Charlie Gibson from Edison Investment Research. Charlie, good to talk to you going into 2021. I just want to get your appraisal, if you can, on how you view life in 2020 for the mining sector. How's it been?
Jeremy, it's been a very good year, I would have said. It hasn't been a smooth year in terms of performance, but it has been a very good year in terms of performance. Of the 18 commodities metals, really, that I track on a regular basis, 10 are up, 8 are down. The average performance has been up 12% over the course of the year in US dollar terms. So that's pretty significantly outperforming most equity indices that we'd look at. But if you look at the top performing of those metals, and this was unquestionably a surprise, it's iron ore is the metal that has outperformed all others, up roughly 60%, from sort of just under $100 a ton to $155 a ton, something like that, followed by silver, copper, nickel, palladium, zinc, and then gold. One of the things that has really interested me is how most of the metals that have performed have been the ones that have performed also in the sort of 4 years since 2016 and also in the 19 years since 2002. So really, it's copper, silver, palladium, gold, all near the top end of the performance table, just as they have been for the last, well, effectively 2 decades.
What is the underlying dynamic there that's going on here? Is it the fact that we have less supply coming on? As I mentioned at the top, COVID has twisted the markets unbelievably this year. Of course, this time last year, we didn't even know this was coming. So we've had to learn very, very fast. But one of the things I have learned is the fact that many mines have had to close. So there has been a restriction of supply coming through, and that tends on the whole to lift prices. But at the same time, you mentioned iron ore. I mean, iron ore, I think China gets about 60% of its iron ore, I believe, from Australia. And of course, you can see, can't you, then that China is doing relatively well now in terms of demand. It's got a lot of demands coming out of China. So both the fact that we got restricted supply and in some cases increased demand has helped prices rise. What has been the real message to be taken away from that aspect of the environment?
Well, I think in this case, in 2020, it was one of timing. Because if you remember, as we went into the coronavirus crisis, and it seems like years ago now, but actually February, March time, what was happening is the crisis was in China, and everyone said, oh my God, demand. And of course, the prices of a lot of these things, not so much the precious metals, but certainly the base metals, I was going to say fell off a cliff. It didn't quite fall off a cliff, but they were very, very, very seriously down in February and March time. And then there was a little bit of a break where they steadied. And then what happened is, as the virus spread into the rest of the world, that's when you got the effect on supply. So beforehand, we had reduced demand and supply was the same. And then suddenly we had reduced supply. That balanced things out. And then as China recovered, first of all recovered and then continued to recover, you've got that strong demand and a very, very accommodative sort of monetary policy followed by the People's Bank of China. They're really trying to stimulate the economy. So you've got that, plus COVID waning in China, plus the natural demand come through. You're getting really quite robust economic growth now in China, which, as we all know, accounts for some 40% of demand for commodities globally. So when you've got that mismatch, when you still have the problems around supply, and there's always that possibility, but particularly coming out, I would have said copper and iron ore at the moment, you're seeing suffering from that. And copper stockpiles now at the lowest level they've been since 2014, while you still got that robust demand. And you've seen prices recover. And of course, the extraordinary thing is that prices in the case of copper have recovered to a level that's now quite a bit higher than they were this time last year. Despite, and it's because of that mismatch. It's not because of the fundamental economic outlook is better now than it was then. It's because you've got this mismatch between supply and demand.
What do we take then into 2021? I mean, you mentioned copper at 79.29. This is where we are at the moment. Do you see more weight being added to the likes of copper and those metals that have done particularly well? Do you see 2021 being more of the same?
I think I do. I think in this case, I'd say the trend is your friend. So I think it's still the coppers, the silvers, the palladiums that I would look to. I think you still want an insurance policy in gold, because I don't think that monetary stimulus has yet run its course. So I think there's still the potential for there to be problems in world economies and for central banks to react to that with monetary stimulus. So I would still have something in gold, but yes, I think it's your coppers, your silvers, and your palladiums at the moment which are going to make the running. That's not to say that other metals can't do well as well, and some of the metal we have seen huge amounts of volatility in the last 4 or so years, and they have the potential to bounce very, very strongly. So two of the worst performers this year, for example, vanadium and cobalt, if you get a squeeze there, you could see their share prices, not their share prices, sorry, their prices go to multiple they are at the moment. The other one that I would look out for, the worst performer this year, was actually lithium. And that is because I think you've got an immature industry, a lot depending on China in terms of electric vehicle uptake, and that was hurt in the early part of the year. It seems to have recovered somewhat in September, October, November. There are signs it is recovering, but lithium down about 40% over the course of 2020. So I think that has, if most of the metals that have been making the running in 2020 were ones where, if you like, the secular trend is behind them, then lithium is actually one where the secular trend is behind it. The move towards electrification, net zero carbon by 2030, no new diesel or petrol engines, that sort of thing. Lithium is the obvious standout as the metal that actually should be benefiting from that secular trend, but actually the price has done appallingly. Again, it's because of this sort of mismatch between supply and demand. And that, if you like, I think has a significant potential to bounce.
Yeah. Let's focus in on China as one of the main demand drivers this year. Is that going to continue, do you think, into 2021? Has China now got all it needs in terms of supply, or is it going to continue demanding more metals as we go into next year?
There is no chance of the supply going away anytime soon in China. The rate at which the country is industrializing, the amount of the intensity of use of all these metals per head of the population in China is still actually relatively low. And so in terms of its continuing economic development, yes, it will definitely need more metals. Now, is the government giving that a helping hand, or has it done in 2020? Yes, it has done by policies, not only the government, but the People's Bank of China, which have been designed to stimulate the economy. Those will continue into 2021. They might not be quite as accommodative, quite as stimulative as they were in 2020, but they will still be there. And the extent to which they are less accommodative going forward in 2021 will only reflect the fact that the underlying economy is probably growing more strongly. So whether it's as a result of government stimulus or, if you like, the natural underlying economic demand of the country, there is still going to be that demand without question from China there. And you can see that in iron ore at the moment, where the price has gone to the same levels it was at in this time 10 years ago in 2020. This was something that no analyst foresaw, I would have said, 12 months ago, but, it has happened, and there is that potential. Well, all the factors and forces are in place for that to continue into certainly the foreseeable future. It's superimposed on top of that. The Western economies, the governments and the central banks are also trying to stimulate their economies as well. So we've almost got a perfect, I don't think you can have a perfect storm, can you? A perfect calm, if you like, in terms of what's behind, what is all the factors and forces that are pushing commodities higher. And I think they will all continue into 2021 without doubt.
Yeah, one of the other things, of course, talking politics, is that we've got a Joe Biden presidency going into 2021 as well. And we know that the Democrats tend on the whole to do more infrastructure spending. We've heard a lot of positive words coming out of what will be the White House come mid-January 2021. Is this going to help the market, do you think, or do you think the amount of money they're talking about here in terms of infrastructure spending is not really going to make that much of a difference compared to what China is going to be demanding?
It will certainly make less difference than what China is demanding, but it incrementally adds to the demand situation at a time when supply is relatively tight, stockpiles are relatively low, and if there are any hiccups in supply at all, like we've seen with Vale lowering its guidance relatively recently for iron ore production out of Brazil, you get any hiccups like that, and you get this mismatch between the two, and it can result in certainly quite sharp price moves. But in this case, I mean, I think the story is that underlying everything else, you have this strong base of demand growth. It'll come from China. It'll come from America. I'm not sure the demand would have been much less had Donald Trump won the election, because he was talking about stimulus as well. And that's one of the things you notice about, you look at the politics, it's almost across parties, across right and left at the moment, of all political persuasions, is everyone agrees that there is a need for stimulus at the moment.
Are we going to get much of the story of deficits coming through in some of these, for example, copper? I'm hearing that there's just not enough copper around to supply the ultimate demand. You're talking about electric vehicles earlier on. We've got to get this electrification network up and running. And I'm hearing that we're going to have to get some massive copper installed in terms of quantity to get all the electric vehicles rolled out, as many economies are hoping they will be in the next 10 or 15 years or so. So are we going to hear a lot more about the deficit story in terms of supply for metals?
I think so, absolutely, especially in a situation where you've got very low stockpiles already. I mean, deficit, a supply side deficit doesn't matter so much if you've got very high stockpiles, but if you've got very low stockpiles, almost anything that interrupts that, the only way that the market can really rationally or sensibly react to that is by putting the price up, which will attempt to dampen that demand. But it's working both ways, if you like. The price goes up to try and dampen what demand is, but also to try and stimulate new supply. So if you like, the price is front and center of the mechanism by which the copper that is required by all these economies is going to get into those economies. And if you look at the sort of increases that are required for the electrification of cars, there are many multiples of the amount of copper in an electric car than there are in an internal combustion car. Obviously, lithium is the same. So as long as that story progresses, you can set aside the current sort of trials and tribulations of the global economy. Those alone would augur well for higher prices. You superimpose electrification on top of it, and then, if you like, you've got two things where all the pressure on prices is upwards rather than anything else.
What about M&A? You're talking there about the outlook for metals. What about within corporates? Do you see that changing very much in terms of ownership of the metals? We're hearing a lot, of course, about China buying into a lot of resources around the world. But how about the change in landscape corporate-wise? You say you look on the whole at companies that tend on the whole to be smaller than the larger big caps, the ones we know like Rio and BHP, of course. In amongst the smaller cap companies, do you see a lot of those now being absorbed into larger cap businesses in order to be able to defend the approaches from places like China?
I don't know if it'll be to defend against encroachment from China, but there is, at the same time as all these commodity prices are rising, there is an absolute imperative, I suppose, on company managements to grow their companies in any way they can. Now, that can be organically via the drill bit, exploring, finding more of whatever commodity is they're looking for. The other method is via mergers and acquisitions, and where companies can identify value, i.e. a company is valued at less than fundamentally it should be, then that is an opportunity for them to do so in an accretive manner. So, I can talk to you about one company that I know, Endeavour Mining from Canada, which has made 2 acquisitions so far this year, both of companies that are in production. Endeavour was certainly the largest, but it's taken it from being a sort of medium-sized player, if you like, into the ranks of the top 10 gold producers. So it acquired Semafo in about March this year, and in late November it announced that it was also buying Teranga, both of them producers of gold in West Africa. But Endeavour has done more than most in terms of mergers and acquisitions in that respect, but the same pressure will be on other companies as well to do the same sort of thing. So I think that's where most of the activity is going to be. It's going to be in the medium-sized companies that have cash flow that will look either to buy slightly smaller, but also producing companies, but also potentially some of the explorers as well. The big companies, I think, they will dance to their own tune, and they tend to do very, very big acquisitions quite rarely, but when they do it, you really notice it. So, Glencore, Xstrata, that sort of thing. So I don't think you're going to see them so much, certainly not as frequently in the market, but there is absolutely a potential for a big mega merger of some description out there over the course of, however long it takes, the next 12, 24 months.
Yeah, you talk about explorers. I mean, it's been tough times for some of them, I know, in terms of trying to raise money, for example. There's not much money around at the moment for these explorers looking for opportunities within the mining sector. And that, of course, is one way in which these young, small companies can actually benefit by being taken over, can't they? Because, as you say, the deeper pockets from some of the bigger players in the market. What is the environment like going into 2021 in terms of money available from banks that want to loan to these companies that are so speculative?
The answer is a lot better than it was 12 months ago. It won't be the case that all companies will find it easy. Actually, bank lending for project finance is not quite so difficult. The thing that juniors particularly really struggle with is with equity. And traditionally, or 12 months ago, if you wanted to raise equity, you had to do it at quite a discounted price. Now, what's interesting is you look at some of those juniors who are raising funds, and if it's the right sort of junior with the right management at the right sort of price and the right sort of project and the right sort of commodity, when they announce their fundraisings, you'll see the share price actually move up. And, Rocktech Lithium in Canada is just such a case in point, just in the process of closing a fundraising at the moment. But the share price is now higher than it was when it announced the fundraising. So it gives you what is undoubtedly true is that purse strings, particularly from the perspective of equity investors, are definitely loosening. And there is definitely much more appetite than there was 12 months ago to invest in these juniors.
It sounds like, on the whole, you're looking forward to 2021. Would that be a fair appraisal, or you got some trepidation?
I would say I'm never without trepidation. It's not that there aren't jokers in the pack, but I think I'm probably as optimistic as you're ever likely to see me. Are there jokers in the pack? Yeah, of course. There's the big COVID joker. We've got a vaccine. We may have 3 vaccines. We don't actually know how long they're going to last. In terms of your immunity, if it turns out that immunity is 4 or 6 months, then we're slightly going back to, I won't say we're going back to square one, but we definitely slid down a snakes and ladders snake, if you like. So that's definitely one of the jokers in the pack that we need to be very, very aware of. And that, of course, will have all sorts of economic ramifications. So it's not that I'm without trepidation. I like to think that I'm realistic towards the possibilities of these things. But, short of one of those things, if you look at the situation we're in at the moment, it's about as good as it can be for commodities. There's some economic growth. It's not strong, but as a result, there is some. And at the same time, you've got this accommodative stance from pretty much all of the world's central banks trying to get things going. And that is a recipe for strength in the commodities markets, and always has been traditionally. So, yeah, I'm about as far from trepidation as I can possibly be, while still recognizing some of the potential pitfalls.
Great. Look, Charlie, it's great to catch up with you. Thanks indeed. Here we are now, mid-December, so it's just about the opportunity to wish you a happy Christmas and a good New Year. And we're looking forward to speaking to you again in 2021. Thanks for your time.
Thank you.
That's Charles Gibson. He's a director at Edison Investment Research. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.